You're listening to Indications by the Conference Board.
Hello, welcome to this episode of the U.S. Labor Market Roundup, our regular podcast series where we break down the monthly U.S. Bureau of Labor Statistics jobs report and identify key trends in the U.S. job market that business leaders should know about. We also unpack some of the relevant policy implications for the future workforce. I'm Elizabeth Crowfoot, Senior Economist at the Committee for Economic Development of the Conference Board. Today we'll be discussing the June jobs report, as well as some of the factors that will make it difficult to interpret the impact of some states prematurely ending unemployment insurance benefit programs on their labor supply. But first, let me introduce my two regular guests and fellow labor market experts. Gad Levanon, head of our Labor Markets Institute and a regular contributor in Forbes and CNN, and Frank Steemers, senior economist at the Conference Board, focusing on U.S. and global labor markets. Gad and Frank, thanks for joining me.
Thanks, Elizabeth. Pleasure.
Yeah, thank you, Elizabeth.
Great. So with this jobs report, we definitely had some head-scratching moments. So let's look under the hood to make some sense of it. U.S. employers added 850,000 jobs in June, but at the same time, the unemployment rate ticked up to 5.9% from 5.8% in May. The leisure and hospitality industry continues to drive overall employment growth, making up 40% of job gains. Those jobs were primarily added in restaurants and bars, but also in hotels and arts, entertainment, and recreation services. Local and state government education also saw substantial gain, making up over a quarter of total employment growth. But that primarily reflects the seasonal adjustment that is inflating job gains, as the typical teacher layoffs during the summer did not occur to the same degree as in the past, given that teacher shortages that many school districts were already experiencing. Weakness in the labor market was seen in construction, which reported job losses for the third consecutive month, and in healthcare, which saw a decline in employment for the first time since January. And I mentioned that the unemployment rate ticked up, and that's in spite of strong job gains and a steady labor force participation rate in June. But the rise in unemployment shouldn't be interpreted as worsening labor market conditions. It was mostly related to technical reasons, such as the employment and unemployment numbers being collected from different surveys. And the longer-term trend in the unemployment rate is still down, and more people are finding a job. The labor force participation rate, however, increased by a whole percentage point for Black men, the largest increase in a year, and Black and Hispanic women also saw substantial improvements, but their workforce participation is still well below pre-pandemic levels. White and Asian workers saw declines in participation. And finally, the number of involuntary part-time workers, those that would prefer to work full-time if they could, fell substantially, while the number of voluntary part-time workers jumped, both getting closer to pre-COVID levels and signaling that people are returning to their pre-pandemic labor market status. Overall, this jobs report highlights a dichotomy that we're seeing in the labor market, with some measures pointing to a tighter labor market, such as record quits, record job openings, and rising wages, and other data pointing to relative slack in the labor market. For example, that we're still 6.8 million jobs in the hole, and that we have a labor force that is still 3.4 million below pre-COVID levels. So with that set up, let's turn to our labor market experts. Frank, as I mentioned, labor force participation rates are starting to increase for certain demographic groups, but they're still below pre-pandemic levels, especially for women. What do you expect to see in terms of workforce participation over the next few months?
Yeah, thank you, Elizabeth. I think after the start of the pandemic, of course, with a huge drop in participation, which made sense, governments were even asking people to stay home. Then in the summer of 2020, we had seen some improvement, but actually since then, so over the last 12 months, there's not really happening a lot when you look at the participation rates, and especially since the start of 2021, when the economies are now reopening, more businesses can run at full capacity. We had expected to also see some more improvements in participation, but we haven't really seen that yet. Maybe if you look at some groups, so for example, men and women aged 25 to 54 years old, there starts to be a slight increase in participation, but it continues to be well below pre-pandemic levels. So I think we still see these labor supply constraints, such as the fear to contract COVID-19, parents with childcare issues, or parents that need to take care of children during remote work time. And of course, we have also elevated unemployment benefits, which have given some workers more bargaining power. So they may not take the first job offer that they see, but they may wait out until they see a better job offer. So I think when we go into the second half of 2021, and we will then likely see some of these supply constraints ease, and that will maybe also mean that participation can start rising, and then again from then onwards. Still, I think we should keep in mind that especially after many recessions in the US, we have seen permanently people dropping out of the labor force. So we see, for example, that there are still people discouraged. We also have some older workers who are now already retiring earlier than they may have had expected before the pandemic. And some of these workers may just not return anymore. So it could very well be that we are going to see an increase in the participation rate over the next couple of months, but that we are going to continue to be below pre-pandemic labor force participation rates, maybe for a very, very long time, as not all workers will return to the labor market. So that would mean that overall for employers, of course, they have to deal with the labor pool that is just going to be smaller, and especially workers or employers that are looking for workers without a bachelor's degree. So, for example, young men without a bachelor's degree, especially there, we often see big drops in participation. And also now there's still not a lot of improvements there. And then, of course, for the economy overall, for employees, it is more difficult to recruit. But for the economy, it will also mean a smaller labor force. So often that means also less economic growth. So overall, for the economy, it would also be a disappointment. So I think that is in a nutshell the labor force participation rate trends. And I believe, Elizabeth, you want to talk a little bit more about one of the reasons why the labor supply is still constrained, and that are the federal unemployment benefits.
Right. As I highlighted in our previous labor market Roundup episode, there are 25 states that have already ended or plan to end the Enhanced Unemployment Insurance, or UI, benefits ahead of the September 6th expiration nationally. And the argument there being that the supplemental funds disincentivize workers from filling open positions. And now that states are dropping those benefits, it's a good time to review some of the factors that might make it difficult to interpret the impact of recent changes in benefit programs on the labor supply. So first of all, I want to point out that we will naturally see the initial and continuing claims for special pandemic-related UI programs, such as those for freelancers and gig workers, move to zero, as those programs in certain states will come to an end. And second, initial claims for regular state benefits may also decline ahead of expiration dates if people are more likely to take jobs in anticipation of a loss of income. And at the same time, those initial claims may continue to rise in the short term as unemployed workers falling off an expiring program retest their eligibility for that regular state benefit. Third, fraud and filing backlogs are still an issue, and they continue to create a lot of noise in the data, and they have undermined the usefulness of weekly unemployment insurance claims as a labor market indicator throughout the entire pandemic. And fourth, states are fundamentally different in their average earnings and sectoral makeup, their reported infection and vaccination rates, the degree to which schools and other childcare options have fully reopened, and the generosity of the regular UI benefit, all which are factors that will impact the change in the labor supply as a result of the change in the UI programs. All this is to say that declining UI benefit claims shouldn't be interpreted solely as more people moving into jobs. There will be some of that, but it also will reflect fewer people applying for benefits that are less available. The key takeaway being that there are many factors at play here that drive overall labor supply that are important to take into account as we start to monitor the impact of the UI system reverting back to its pre-pandemic state. Although we can immediately track changes in the initial and continuing claims data as these programs expire, the true picture of the impact on the labor supply will start to come to light in August when state-level payroll data are available for July, where July is the first month that we start to capture the labor supply impact for some states. So, Gad, now turning to you, ultimately, businesses have been launching these massive recruitment efforts in search for workers by increasing wages and offering hiring bonuses and other incentives, especially in some industries more than others. So, over the last 3 months, at an annualized rate, average hourly earnings in leisure and hospitality, for example, are up about 15% and about 9% in retail. And that's compared to about a 6% pace of growth in earnings over the last 3 months for the economy overall. Gad, can you elaborate a little bit more on some of the compensation trends that we're seeing, and how long do you think elevated wage growth is going to last?
Yes, thanks, Elizabeth. Yeah, I think, at the moment, there are no signs that the labor shortage in the US is easing. And as a result, when companies are struggling to recruit and struggling to retain workers, it's no wonder that they are raising wages. As you mentioned, wages are growing extremely fast now, the fastest in 35 years. And that's probably likely to continue in the coming months. I guess in the fourth quarter, when, as you mentioned, some of the factors that are causing those labor shortages or labor supply issues will ease, we're probably going to see wage growth for new hires, especially, moderate significantly. So I do expect overall wage growth to be lower towards the end of 2021 and into 2022, but there will be other factors that will still push wages forward. One is the simple fact that a lot of the new hires that benefited from the burst of wages during the labor shortage period are going to make more than existing, more experienced workers, and that is not a sustainable situation. It will force some employers to be more proactive and raise wages, and it may also lead to a lot of quits among the more experienced workers that will want to find jobs that give them a higher wage. So overall, that would push wages forward. Another important factor is inflation. Today we got the inflation numbers for June, the CPI numbers, and they are very strong. In fact, in the last 3 months, core consumer price index increased by double digits, by 10.6%, which is the first time it's in double digits in 40 years. And that will have some impact on wages, even though there, in most companies, or almost all, there is no like an automatic mechanism of cost of living adjustment. I think there will be strong demand from workers to have some of that compensation. So that could further push wages in 2022. We have our salary increase budget that we just ran. Shows that employers are expecting to have higher average raises in 2022 versus 2021. I think another important trend that will impact wages and compensation in the coming year is the shift to remote work. I think especially for employers operating in expensive labor market, they will be able to lower overall labor costs by employing more workers in cheaper labor markets. And also maybe it will cause some, in many companies, they kind of stuck to a national structure, and maybe more companies will move to a structure where they allow differentiation across geographies in how much they compensate workers. So those are some of the main trends, Elizabeth.
Great. And I just want to highlight that report that you mentioned, the U.S. salary increase budgets for 2022 that just came out on the Conference Board website in June. So definitely check that out for more discussion about these wage and compensation trends. So that's about all the time that we have for today. I've been speaking with Gad Lebanon and Frank Steamers from the Conference Board Labor Markets Institute about the main insights from the June jobs report. Gad and Frank, thanks so much for joining me today.
Yeah, thank you, Elizabeth.
Thank you very much.
And thanks to all of you for listening. Please join us for the next U.S. Labor Markets Roundup as we discuss the July jobs report. Don't forget to subscribe to both the Indications and Sustaining Capitalism podcast series from the Conference Board through your favorite podcast app. Thanks again for listening. I'm Elizabeth Crowfoot with the Committee for Economic Development of the Conference Board.
This has been Indications from the Conference Board.